Hello, my name is Dr. George Mochocki and welcome to Retail Merchandising. Today we're going to be covering Chapter 11, Inventory Valuation. What does that mean? We've talked the last couple of chapters on inventory turnover. We discussed accounting last chapter, talking about the income statement, the balance statement, the cash flow, how your inventory has a direct correlation to all of those three financial statements. So today we're going to talk about your inventory. Your inventory, what's the value of inventory? How do I keep, remember, your inventory is your bloodline. It is your soul. It is your business. If you don't have inventory, you don't have anything to sell. I mean, unless you're a service thing, you have to have some kind of inventory. If I'm doing, cutting hair, I carry some kind of inventory for, a hair product. But let's just talk. I'm a regular retail merchandising store. I'm a fashion designer. I am selling a clothesline. I'm selling my designer creation. I'm selling other designers' brand. I'm a boutique, and here's my business. If I don't know how much inventory I have, how much I should charge, when to get rid of inventory, what's the value, is there any kind of shrinkage in my inventory, is there any kind of overage in my inventory that I miscalculated, and now my books are off. Remember, point of sale, how do I utilize technology so that I could track what items are sold, what color was sold, and I could replenish them right away from the manufacturer, or at least me be able to know I have to make this order. All this makes a difference. Lifo, Fifo, one is to give you a tax break. The other one is to help you manage your operations and your costs of doing business. So it's strictly is how to increase or decrease your expenses. So there's which system you utilize. It's an accounting principle. Remember, you're into fashion, merchandising. You have to understand the business side. You're not going to be successful. Sure, you're going to be the best buyer. You know what's selling and everything else. But not only now, you have to know what's selling. You have to know what the cost is and how much the inventory is worth, and how long should I keep it before the inventory starts losing value, or the inventory may be gaining value, depending on how I write it and how I present it to my accounting principal, or how I present it to my clientele. I have to know my inventory. If they're coming in there and say I got one left and it's not there, he or she's going to be upset. I've lost it, or I say no, we're all out, and in reality I have a lot of inventory, just wasn't put into the system now, so I've lost the sale. So you have to understand it. So we have here one side in here, and I'm just going to go. The one side I'm talking about anti-shoplifting. If I look at shoplifting, we're going to talk about internal loss and external. What you'll find out, most of your theft and everything else is done internally. You don't have people outside. They're going to come and rip you off, but majority, higher percentage is going to be your employees maybe ripping you off if you don't have procedures, some kind of security to keep them in check and balance. Don't make it easy so they walk away with it. Most employees are honest, but the situation may just be there. It'd be too tempting. Okay, so you have this one, and I'm not going to. We could go on here. If I look on this side, it says how does stuff work. And on this side here, what I want to do is I'm just going to type in anti-shoplifting devices. Let's see what it comes up with. Okay, there we go. Anti-shoplifting on the crease. Here's, let's see, tips, download the guide. Anti-devices retail. Let's look at the one shopping. Look what they have. Checkpoint free. You see a lot of these people walk over. Do they work? Some people, they don't work. It's a deterrent. They never work. The lights just go on and off every in and out. But some of them are actual. You have these that clip on here. You have these little tags that are in the wallets or towels in places. You have these locks. All these are security devices. Not inexpensive. It's going to cost you. How much do you need this? Like $2,000 just for these one set of doors. Does it work? I mean, I got to have all the devices working with this device. Is it practical? That's where a lot of times the manufacturers and everything else will already have the clothing embedded or the devices embedded within it. We're gonna go in the future. We're gonna have the radio frequency tags in here. Those are going to be also your anti-devices. So everyone's going to have one. You can see people coming, going. Did they pay for it? Did it turn it on? Did it turn it off? Technology security is going to be more available to smaller businesses at a more affordable cost. Right now, the best thing is just be aware of small business. Have a camera is more just being aware of your surroundings. Don't be naive. People come in there, keep an eye. Don't watch them so they'll walk out of your store. But that is part of your shrinkage. So this is just an article on here. All right, I want to throw something else in. Most of the people at accounting, it's not an accounting class, but it lets you understand. Now, inventory is very important from a retail merchandising, because if you don't have your inventory, you have nothing to sell. You're out of business. So I have to understand, what should I charge? My cost, my inventory went up, but I still have old inventory. Should I charge it at the newer price or the other price? That's where Lifo, Fifo comes in. So why is inventory important? Let's get this going. I'll try to keep this underneath a half an hour. This is not, look, I enjoyed the finance. I enjoyed the accounting portion. That's another part of your brain. Remember, it gives you a creativity side a little break. Put the logical side, but then have the two sides of the brain working together. That's why I use the concept math. Most people, we don't think this way. We take things all over, and I could bounce all over. Utilize these mind maps. They're there for you. They work well. Okay, remember, so this is a supplement to an online class you're taking me. This is your only lecture, or to a face-to-face class. And if I miss something, because I like to go more into discussion, follow along. Read the book first. Author does a great job. It's more in detail. Mine just a quick overview. So you read it, first exposure. You wrote your notes down using my mind maps that you printed out, and then you listen to this recording, this lecture. Add on what you forgot. It helps you in note taking. Helps you remember. Keeps on adding, and then when you take the quizzes, you max the thing, you come out with a good grade that you deserve. Okay, so inventory represents the amount of money a retailer, me, has invested in stock. How much I got invested in there? I put in so much, or a farmer, look at a farmer, how much seed I got, how much plant, how much yield I'm going to get. All financial terms, all farming terms. I put so much in, I expect so much on the return of my investment. All sales come from inventory. Gotta have something to sell. It comes out of my inventory. On the balance sheet, inventory is an asset, right? That means it gives me, if something goes wrong, it says, hey, it's like collateral. My inventory has an impact on my net worth or my equity, owner's equity, when I'm looking at going for a loan, or I need the short-term financing to get my inventory. It makes me look good on the paper. Okay, and an income statement, both come from a cost of goods sold. I got to know exactly what it cost me for the goods sold. I brought it for this much. It sat here for this much. I had to air condition it for this much. I had to handle this much. All those costs are associated by the time I sell it. That's what it cost me. Cost of goods sold is the total cost of my inventory, not just the material. So you have to have true cost. That's why when you take an accounting, now you understand, how do I charge? Remember, I want to give the government what they belong, but this is part of doing business, so it's part of my expense, a part of me buying the product. This is my cost, not that I paid $2 for it, but then I kept it in. And if I look at furniture, a lot of times furniture, just to get off the subject, furniture is always high end. You can always talk your way down on furniture because it sits there for so long time. So they're trying to recoup the cost and say, here's $3,000 for the couch. You only maybe paid $500 for it, but they may have it in inventory for 6 months, 7 months because it's high end before they sell it. So you could always negotiate down. They're still making money. Okay, so I made $700. I got it for $500. But look at the time. How much it sat there? How much space it used up? How much time I got it dusted, cleaned it, and I did. It was space there, taking space, but I didn't sell it, so it wasn't moving. So my inventory turnover is very slow. I try to recoup that and place that as part of my cost of my inventory. Okay. Now, inventory values to be paired for financial statements, right? That's the reason you're doing inventory. Retailers need to value the inventory. How are you going to write it off? How much is inventory? What is something stolen? What are you going to give the value of it? What I paid for it, or what it was worth if I could have sold it? There's two different costs you're looking at. Good point. Okay, obtain the cost of goods sold is part of the income statement. Retailers determine before the month, right? Purchases after at the end of the month, before the month, plus purchases at the end of the month. You subtract them. Physical inventory, let's look at what it consists of. I look at the most reliable method. You have to count it. The numbers and everything else. Here's what the machine says. Here's what the system tells me through my point of purchase we're going to be talking about, through my barcode, whatever, every time they scan it. But the best way, even at Walmart, Kmart, Target, the large store, you'll see them like flies come in there. They're all taking, they're just making sure that the numbers they have on stock, on shelf, in the warehouse are actual numbers that meet the book. So the physical inventory is the most accurate, most expensive. And you can't take inventory every day to see how much you do it. So you're utilizing the point of purchase that once the person buys it. That's why a lot of times they'll say, what do you have, Pepsi, Coke? They got to have it so they know we sold so much Pepsi, we didn't sell enough Coke, or we sold this flavor versus this flavor. For $10, which flavors went more? So next time I understand it, or I could replenish my my inventory and my stock right away because it sends it to the manufacturer or to the warehouse or the supplier or to the job racker that we talked about in previous chapters, and he or she brings it out to the store. Actual counting identifies all items by price and some by style, depends how you have it. Time consuming, tedious by vital. The larger ones you want to do the face ones. The real small ones, little items, you're just going to take a gamble. It's not worth it. You just take by the bag. You have to use your common sense. You're going to spend something for $25, $20, counting 20,000 pieces. I could do it by weight or by some other way of measuring. The larger items is unless you're doing razor blades or you're doing something that's high end or computer chips, and you have to because each item costs me like a higher cost. Okay, results are compared to the books, inventory, reconciliation, and then that's where we do adjustments. So you could say, here's loss, and some of it, where did it go? We got an inventory shrinkage. Was it stolen, or was it not properly returned back into the system? This we have to find out because it makes a big difference. How do I write it off? Okay, now perpetual inventory system, what does it mean? Keeps on running a count of inventory by updating each transaction. That's what the technology does. It keeps on doing it. Every time I sell something or buy something, I got the scan, boom, boom, I run it through. Okay, periodic inventory system, makes sense. You do it periodically. Relies on the physical count of inventory done periodic. A lot of times you have this is always constantly running, and every maybe quarter, depends on the store, depends what's important, on which items. That if you start seeing a shrinkage, you want to wait to the quarter, you may do it more often. And the count is done periodically, is done physically. And then now the book inventory, when I look at the book inventory, perpetual inventory adjusts the purchases in a physical. In theory, the book inventory should always equal the physical, but that's not reality. When new goods come in, was the books adjusted? I got inventory in there, and they didn't scan it in there, or didn't enter it in because of the end of the day, and they forgot it. And I got this inventory sitting there. Customers are asking for it, and we say, hey, we don't have it. We don't know where it's at. It's around the corner, and I'm calling up the vendor, the manufacturer, supplier, and it's sitting on the dock. I just didn't log it in. That's something that you should take care of because you want that inventory in at that time. Because what it's at the beginning of the month, and it depends when I show it on the books, may have a big impact on my income for that month or my expenses. All right, the profitability. Remember, because it's an expense. If I don't show it as an expense, then I made all this money, but I'm selling the inventory and I haven't recorded it yet. So how did this happen? I got extra cash in there, but we got zero, and I already sold 5 more. Something's wrong. Then it messes up my books, and I got to go back at what do you call it, the periodic inventory, and have a physical. That's costly. I want to make sure everything runs properly. So the system, I do my checks and balances just to make sure I'm in there and make the adjustments as needed. Okay, the formula inventory on hand, beginning of the first period, plus the purchases, minus the inventory at the end of the fiscal period will equal your cost of goods sold. How much is my cost of goods sold? And here's a note. All departments do not have the same inventory schedule. Again, I'm selling a lot of little stuff. I may only have it when it's a quarter because if they're stealing a lot of little penny stuff, it's not worth the time to do it. I want it, but that's not where my theft is. My theft is my high-end items. You could always know it's the computer cameras, where where the computers are at, the jewelry, the high-end items is where your theft is happening. It's going to hurt your bottom line. Okay, so now the next one, overage and shortage. I always like overage, but it's not the overage. How do they get there? Okay, so overage. In reality, book inventory and physical inventory seldom match. Discrepancies are the rule. Book inventory is less than the physical, which means an overage occurred. Shipment not noted in. That's what we talked about before. How do I get more supplies in than I show in the book? Something went wrong. Somebody made an error someplace. I should correct that, because otherwise my whole accounting procedures and process will throw off my bottom line, and it could look like I'm covering up something. I have to know the actual costs. I have to know what inventory I have. A small boutique, you know it. A larger business is a little harder, because you have different products and everything else to keep that inventory in check. Think of what a Walmart has to do with all that, versus a little boutique that may have maybe 5 to 10 different kind of styles. Something like that French one that we saw, the other one, where they had a small boutique tailor. He knows everything. He's just missing words to that. Very easy to keep an eye on that. What happens a lot of times, I'll be working with inventories with businesses. They have a safety stock, and some of the employees are just taking it out, recording it, and they're just replenishing it. Are they taking it home? Or are they actually using it on the job? And if they're using it on the job, I should charge accordingly to the job that the equipment been used at. I understand that sometimes they call like a miscellaneous. Okay, shortages, shrinking happens when physical inventory is listed in a book, and there's a question real easy. And what's shortage? It could be damage, wasn't recorded, it was turned in, we had the wrong number, didn't have the receipt, something happened, I didn't tag it right, or somebody stole it, internal or external. Causes for shortage, external theft. Somebody outside, you always got to keep an eye on them. Internal theft is just as high, because they know the weaknesses. They're not getting paid. They think they should get a raise. They're upset with you, whatever. They're just, opportunities. Remember, so you got the camera, you had the security. That's something you don't let them know. My security cameras aren't working, so be careful unless you really trust your employee. And you should trust. Small business, you should trust your employees. If you don't trust your employees, let them go. It's like if they're going to rip you off, and I'm sorry, and then do it, you can't trust them, because they know more about your business than anyone else. The larger store, I have different employees, so it's my check and balance. They're watching. Smaller store, you leave them alone, you trust them. If you trust a good employee, he or she's the one that you want to keep. Don't rip them off, treat them well, and they won't steal from you. Some do all just because there's some other issues in their life that they need the money or something. Okay, then you have the other one is clerical errors. 30 T-shirts at $25 each. Enter the $20 instead of $25. You'll have $100.50 shortage. They entered the wrong number. $25. They weren't paying attention. Oh, it's on a discount. I just hit the wrong number. Make sure. And that's something you lost it, but that's where you may need a training for employees to make sure they look at it. Or they had you raised your prices, but you didn't change the prices within the in the computer, point of purchase, and it recorded the wrong one. Okay, tracking shortages. Shortages lead to loss of profits, income. Okay, reducing gross margins, and retailers track by department or store merchandise or categories. The razor blades. If you look at razor blades, they're so expensive now. For 5 razor blades, it costs you $40 to get them all locked up. I don't even like buying them. I gotta ask somebody to open up a razor blade. It's safer to get drugs. I'm just kidding. But because it's something else, people will steal them, you can sell them, and there's no way of tracing them. Just a razor blade. You know what I mean? There's no identity number saying yes, he stole this for Walmart or Kmart or something else. Going in the future, they'll have that radio frequency chip in there. They'll know exactly where that razor blade came from, but it isn't there yet. So anyway, that's tracking. Shortages. By department. Which ones do I lock up and why? Okay. Okay. Now, shoplifting devices are designed to. Here they are. Look at it. They're all over. You got them all locked up. Are designed to do what? They're locked in here. They're in a tag. Look at these big tags. They're hard to take off. But do they work? Yes, no, maybe not. Put a hole in them. The new ones are real small. You don't need them because people know how to take them out. They got the tools. So if buy a wallet. If you look at a wallet, make sure they scan it because in a wallet they got it right in the tag where you think you take that off. Inside they have it. Underneath they have it. Not a cheap wallet. A better wallet. They have more. They have more than the wallet's worth in all these anti-tags. So you're doing pretty good. All right. The design. Remember, the design to detour, to keep the person honest. Reduce inventory shortages caused by shopping. I know Home Depot, a lot of times when I talk to employees that work at Home Depot, they do things for shoplifting. They're real friendly. How can I help you all the time? And the whole thing, they said if somebody makes contact with somebody, you have a higher of not shoplifting because they saw my face. Shoplifters, that person that's in the back, and no one sees it, in and out. Now somebody made contact with me, so now when they say, how you doing? I'm thinking, am I a shoplifter, or are they just being customer or being friendly and trying to help me? It does both, but so let's think about it. So I make them happy, but I'm also maybe deterring them from lifting something from me. I'm just using that. Okay, formula, shortages, percentage equals shortages, dollars, divided by net sales by 100. So you're in the same, when you're looking at the decimals, everything else works when you're, remember, when you do the algebra, 100% here, 100 there. Class, look at me. Taking accounting, look at that. Remember, make sure you take a class on percentages and decimals, and you do fine. You need that. When you're doing it down the road, we're going to talk about pricing, markdowns, markup, and how much do I charge for the product, what's my profit margin. All that is part of the dollar sign. Creative, now you're doing the accounting, the dollar sign, the math. Not real hard, adding, you got a computer, but you have to understand what the number means. Markdown doesn't mean not mark out. If you do a percentage, you're supposed to bring the number down, so not raise the prices up. Okay, so let's look at physical impact of shortages. And we're almost done. Shortages, real quickly, increase cost of goods sold. If it goes up, reduces gross margin and income. If I look, a lot of companies, I know Jewel does, for example, have profit sharing. What's profit sharing? When the company at the year end has a profit, that means after their expenses, everything else. Remember, if people are stealing from me, it increases my expenses because my cost of goods is higher. So let's see. So they have profit sharing. If they don't get any profit, the company doesn't materialize any profit. There's nothing to share. So you see in the individuals who are watching for shoplifting because someone's ripping them off, they have, it reduces my profit. I don't get my year-end profit bonus. So it kind of works well. Remember, that's your motivation for a lot of employees. Now, overages basically decrease the cost of goods sold and increase the gross margin. Because remember, I have more goods in here, but I'm not accounting for that good, so it looks like I'm making a higher profit with less goods. Just think the math. Think it through. You have to look, what am I doing? So, it's good I got the material, but I'm not writing it off, but I'm selling more, but then my costs, my inventory is less, so it means I'm making a higher profit margin. Really, I'm not, because I haven't included the cost of the inventory of the product I'm selling, because it hasn't been in the system, but it's on the shelf being sold. Your system should pick it up. Neither overages or shortages is desirable because each is inaccurate. Remember, I don't get the right numbers. Okay, so now shortages control. Retailers. Employ exhaustive efforts to curb theft. You have to have it. You got cameras, security in aisle 7 if no one's ever there. Cameras bleeping, people kind of looking around. They have a whole thing on security. I might do later on. I got a video where what they do in the security, they come and they look at the person. If you're in an area, because now you got cameras, if you're in an area way too long, unless you're me, I can't see with my glasses. If you're in an area way too long, the camera focuses in. Most people are looking, they find it and move along. If you're there for a few minutes and you're looking around, you've got that guilt looking. Even though you don't see nobody, you got eyes up here watching you. Come on. You're being monitored all over. And in the worst case, so just be aware. So retailers, you curb it. Paper errors that cause overage and shortage. Somebody forgot to enter it. That's a training issue. Make sure you have a good procedure in there. Inequities between book and physical inventories are inevitable. Somebody forgets it. They're busy. They don't scan it in. They turn it in. They forgot to log it in. Or they forgot to put it in. They're busy. They go on hold the night shift. The next shift forgets it and just puts it on the shelf, thinks the other shift did it. Remember, just keep an eye. When you see an overage, catch it right away. You see an underage, what's going on, okay? Now, buyers are accountable for shortages, because remember, I buy it, and then when it comes in, they say, hey, where did it go? You ordered so much, you only got 50. Someone ripped me off. You know, you're supposed to check your inventory. May have low control, controlling monitoring reports of inventory, what came in, what does my shipping label says, and the prices change from when I ordered it or when I bought it, and then what did they charge me, and by communicating clearly. You know, sometimes the manufacturers, here's what I bought for it, when I look at it, think, wait a minute, oh, that was a discount that you only get every 20th blue moon, and there actually is a blue moon, all right? Okay, now stores are vulnerable to shoplifting. There's no way around it. Internal and external pilferages and errors are made. Shortages may also occur at distribution centers. That's why they're looking with that radio frequency. I keep on throwing that in, just like the barcode. So now when the truck comes in, usually what they'll do, they'll take like the middle case and they'll look to make sure no one stole. You know, they can't do everything because it's not time efficient. But now with the radio frequency, they could just with a wand and to know every item. So now if I steal the items out, I can at least leave the chip in there. Just making that, okay? Okay, we did that, and then thinking about it. Okay, when I think about it, look at this. Determine the over and shortage in dollars of unit. A $100 dress is stolen from a store. A markdown of $20 to $16 is recorded as 10 units instead of 50. Right? Real easy. A sale of $100 incorrectly transacted at $120. Goods received on the books at $2 per unit, incorrectly ticketed at $3 per unit. There are 100 units. And this is just homework if you would be doing it. You know, I'm not going to make it on a test, but just so you understand. There could be homework. That's how you have to look at it. Look at the numbers. I got this much. What happened? Where is my shortage? My income went down. I sold all these goods, but my sales is low. I sold more goods than last time. I have the inventory. Do I have the inventory priced differently? Do I have the cost of inventory in there? Okay, so now let's look at point of sale system. When I look at POS, positive point of sales, process sales and credit, right? I come in there to do everything else. Wherever you got a thing, I scan it, or I do it, you know, to try to eliminate the body, or you could do it your self-service. You have one person looking at it. You're scanning, you know, they got the cameras. They can see if you rip them off to get you later on. You got your credit card, your debit card. So it's not worth it. Come on, guys, just pay them fine. You know, I mean, for the $5 item, but people are going to do it. So you're going to catch them, and how, you know, I mean, what are you going to do? Okay, so that's why my point of service. But what it basically does, everything that's scanned, it records it, and it goes right. It's, you know, it's in my perpetual inventory, and it's going back into the system, and it says, okay, it's there. I'm going to take it out of there, and now it's sold. And then it also will send a message, because a lot of things, a lot of the manufacturers are tied with the retailer. It says, hey, we sold 5 of these items, so when you have a delivery truck coming tomorrow, bring in 5 items. Or we sold more than 510. It was a big day. We need the delivery truck to come a day earlier because this is a hot item and I got to keep the shelf going. I don't want to lose that because the items are moving. I have a sale. I don't want an upside customer. And all that is done at your point of service, point of a sales system, okay? The vendor information adjusts the book inventory, plans reorders, and does productivity. Okay, point of sale. So you ever see this? Here's your glasses, point of sale. You come in there, everything's all done. You scan it or they look at it, they bring it in there, and it does everything for you. Okay, so it's a network of computerized cash registers, registered, linked to a central processing point, you know, CPU, or what they call a back officer, and referred to as a back office. So it's recording all this information. You have everything else there. So it's a system for you, but you still have to understand what the numbers are telling you and check on the system. Most of the systems have a backup, so if this goes down, another system picks up. If you look a lot of times, you see like a radio, a TV dish out there. It's basically a microwave sending information automatically to another location. So whatever happens here, you can destroy it to make a difference. It duplicates it, mirrors it. Okay. So let's talk about Lifo and Fifo. My two last thing. Lifo, like a dog. Last in, or first in, first out. Determine the cost of goods sold at the end of a period. That's what it all does. May be harder when purchase cost varies. Remember, because your purchase cost varies, you have a sale, and then the cost of goods sold, or then your inventory changes, and that's why thank goodness for computers and technology does it for you, but you still have to set up which system it's going to be using, Lifo or Fifo, and that's where your accountant comes in, or you can make that determination yourself. Usually accounting knows, but you have to understand what he's talking, Lifo, Fifo, okay? So now, Lifo, last in, first out. Goods brought later, sold before those brought earlier. That's all it's doing, and here's the PowerPoint. So here's how it's look. Last in, first out method, and this is teaching, I think, business math, and I teach at the community college. So once in a while they'll have business people teach this course. Usually have accountants teach it, but it prepares you for accounting and finance. If you take me or another instructor in finance, remember community college. I keep on stressing it. Good bang for your money. Good thing for small businesses. Get your employees learn real quickly. They start off there, and you could give them as a benefit to take one class here, take another class. They have at I know Harper has. They have a business industry that could specifically have a trainer come to your business and help you set up a program specifically for your department or your needs, or you could take a traditional class in one employee to a class like you're taking if you would be looking at this at YouTube. If you're taking this as a class, remember, go to the college so they get their money, the author gets the money, I get paid, pay off my student loans. It's all accounting. It all comes in there. Another stream of income that I utilize. So, if you like this, good information, but really learn it and get the credit. That's what you need. So when you go someplace else, yes, I understand the material. A lot of people know the material, but they're not certified. Certified, you get a credit college for it, and then you could take that, once you get a college degree, a 2-year degree that most places are looking for, 2-year, and you could go for your 4, but you could say, I've got the certification. I could take this. Yes, I know accounting. That's why you're taking the fashion merchandising, the fashion program at Harper College or another community college that you're taking retail merchandising, so you could have that certificate, and then for promotion, or for an investor saying he or she understands the management side of running a business or boutique. Okay, so this is all done. Calculate, step 1 is units to be calculated, beginning inventory, and then last inventory. And here's the numbers. I'm not going to go into it. You have my concept maps. You have this in here. It's just going through there. So how do you inventory? This is the 40 units. I paid it 30. 8 units from 872. 48 units inventory. Remember, because different costs. $8, 9 costs. You see how my cost changes? When did my inventory come in? And what did I pay for the inventory? Makes a big difference. Okay? So that takes care of a LIFO. Now let's go on FIFO. Is first in, first out. So sometimes, no matter what the cost, I want the current. Let's go forward, because that works well for my accounting. And here's the way that looks in. Remember, when it comes in, it goes right out. The same cost, no changes. Remember, so here's my number. First in, 2,000. From last one is 240. It changes different for the same thing, $13, $12.10. I have different costs, and I charge. I adjust accordingly, because that's. But remember, whether you're using LIFO or you're using FIFO, it has to be through the whole thing. You can't just change it for this one quarter and not for the next quarter. You do it for the whole year. Which do you use? In an inflation period, you use FIFO, right? Yields gives you a higher gross margin, your profitability, than LIFO. Also, goods usually sell this way, usually first in, first out. Makes it easier in the book. Okay, which do you use? Okay, if in accounting strategy, LIFO, last in, first out, is to defer income tax by improving cash flow. Useful in inflation. Reduces borrowing, because I'm changing the amount. I bought a whole bunch of stuff at a lower price, but I'm selling them at the higher price when the new inventory comes in. Instead of keeping them equal, I'm using this. It's just an accounting. It's not playing with number. It's legally an accounting strategy to defer income tax. Remember, whether I pay income Uncle Sam or I invest back in the business, I'm paying someone. I want to keep more of the money, so I can invest back in the business, have a higher profitability that helps me with my credit rating and everything else. because I'm a sounder business. It looks good financially for me. Reduces borrowing, higher gross incomes than income, higher gross margins and income. IRS lets retailers use for taxes. LIFO, more money one keeps. It means you expand your business. They get you later on. You want to grow your business. Since expenses or cost of goods are sold are more reduces by revenue, which means I made less and I will pay less taxes. I'm not going to go into it. Read it. Look at this class. Just like you learn anything else, remember, I teach math is something you have to do it in your brain. You have to be able to visualize it. You guys are creative, guys and gals. Visualize this. Take your time. Look at, man, it's so hard. It doesn't make sense. Draw a picture. Do whatever. Use the concept. Figure this out. Once you know it, you're all got it. You got it. Okay? Okay, now FIFO. For financial statement, minimizing taxes, maximizing earning. Okay? So IRS knows this. Remember, they want you to be successful. So remember when you talked about economics, invisible hand, that means you grow, your business will grow, you hire more people, they hire more, we get to tax them more, everyone's happy, the economy's happy, where I'm working, everyone's happy, you're doing well. Okay, so what have you learned? Retail merchandising. It's more than just putting up the pictures up there. It's more than just getting the atmosphere. It's all of that. It's making the brand, the position. But now I have to understand how much is my inventory worth? When do I sell it? How do I maximize my inventory, either to reduce my taxes or increase my profitability because I want to be going for a loan, or reduce my borrowing? How do I control the shortages? How do I control the what do you call it, overages? Is there a training issue? Remember, I'm a small business person. I'm a retail merchandiser. I'm a store manager. I'm an entrepreneur. I'm a store owner. I'm a department head. All of this is the budget. I am the creative person. I'm a good buyer. I do everything else, but I have to know the numbers. I have a lot of individuals because mine is management and marketing. Management is more in the finance and everything else, how to get things done and on time. Marketing is more the creativity, thinking out of the box. How do I sell? And people say, I want to be in marketing because I don't like to do the numbers. I chuckle at them. Look, I may have to do, let's say I'm an account manager. I mean, I'm managing a big account. And accounting comes up with the numbers, or billing comes up with the numbers, or engineering comes up with the design. I, as the account manager or the department head, has to understand those numbers to explain it to my customer or to somebody else. I didn't create them, but I have to know what they mean. Same thing with my inventory. I'm selling inventory. Which ones do I push? Look at some of you in retail. A lot of times your boss will say, or your manager will say, hey, I'll tell you what, I'll give everyone a pizza, or someone will get a bonus, $20, $25, gift certificate, if you move this product here. Everyone sells this product. Focus on this product. Ugly orange. Nothing, orange may be in style. Black, whatever color, plaid, whatever. This is not moving. That's your mission. People start saying, hey, oh yeah, that looks good. This is kind of what's going on. All of a sudden the sales comes in because they're looking for that. What did they do? They just moved that inventory for me. But you understand, because that inventory is costing me, I'm going to lose this. It's diminishing the returns. The sales, the fad's going. Let's get rid of it. Put it on sale. Put it on clearance. Get rid of it now. And don't keep wait on it till last minute. We've talked before. You have to take those markdowns. It's done. It's finished. Don't try to make it. I already move on to the next one, take the loss. Next time don't order so much, or next time order more. It's too late. That's how you learn as a buyer, as a retail merchandiser. You have to understand your inventory, the value of inventory, when to move them, when to keep them, what's going on with it, what happened to it, and how do I maximize that inventory to get every penny out of my inventory, because that's my bloodline in retail merchandising. And so that's why we're talking inventory valuation, is what's the value of my inventory. Again, my name is Dr. George Mochocki, and this is retail merchandising. And this is inventory valuation, chapter 11. And I'll see you, I think, in the next one. We got pricing. Everything else is the last chapter is all with the money. But, you're going to look at how to, different pricing, how when to mark down, how to do discounting. Again, percentages and decimals, a little bit algebra, and you'll do well in business and finance. Sure, you need the stats if you're going up, and the other one, the statistical analysis, and all this other thing, the what if, the probability. But right now, for retail merchandise, this is more than you need at this time. If you understand this, you'll have a real good handle. Once you have that good handle and you're not afraid of the math portion, you can relate the numbers to the good product, to the customer. You are an asset to your organization. You're an asset to your business. It'll grow. If you don't understand that, then hire someone else in there, but you still should know it in your own mind how that works. Again, I'll see you in the next section. My name is Dr. George Mochocki. See you for chapter 12 coming up.